Welcome to This Is Money podcast. I'm Georgie Frost, and joining me and editor Simon Lambert today is deputy editor Lee Boyce. And coming up, gilts are dominating the headlines. The crisis seems to be impacting everything from our pensions to mortgages, the government's economic plans, and everything in between, especially the country's reputation. The Bank of England's got involved again, but what on earth are gilts? And what is really going on? Also today, the first savings rate offering 5% for more than a decade has landed. We ask, is it a bad time to buy your first home? And investment trusts are trading at their biggest average discount in years. Is it a good opportunity to bag a bargain? Don't forget you stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Market updates and conversations around the financial world don't have to be boring. The Digest and Invest podcast by eToro is a great way to tune into what's happening in a fun and easily digestible format. Discover the Digest and Invest podcast at etoro.com/academy/podcasts.
But first, gilt yields continued to surge this week as the Bank of England made its biggest intervention in markets yet. The turmoil in the gilt market has been prompted by the Chancellor's mini budget, which spooked investors last month, and traders have been selling gilts ever since. A lot of talk about pensions, plenty about mortgages. But why? What on earth are we talking about? Simon, now is a good opportunity, I think, to go back to basics, Economics 101. What the heck are gilts? Why are they making the news?
Gilts are IOUs from the British government. They are UK government bonds. That's the name that we give to them. And it is due to their previous gilt-edged status and the fact that at one point they did come with a gilt edge. Basically, what happens is the government says, we would like to raise some money in order to do some stuff. And they issue bonds that investors then buy. And when they're issued, they'll have a face value. So, for example, £100. An investor buys a £100 bond, and that bond promises to pay them a set rate of interest for the life of the bond. The rate of interest is known as the coupon. So, for example, it might have a 4% rate of interest on it, and it might be a 5-year bond. So a 5-year gilt promises to pay the investor 4% every year for 5 years. And then at the end of the 5 years, a date known as maturity, which is when the bond is up, the investor gets all their money back. So it's relatively simple in that sense. And they are considered to be one of the safest investments that you can have, because the government is a safer entity to lend money to and get your interest back on than, for example, a company, which could find its business goes up, could find its business goes down. Some companies are more risky than other companies. So some people may think that some companies are less risky than the government at the moment, but government bonds, especially AAA rated government bonds, are considered to be the safest possible investment. And the UK has top grade government bonds. The US has top grade government bonds. Germany has top grade government bonds. Basically, the idea amongst investors is we put our money here, we will get the money that we are promised every year in interest, and we will definitely get our money back at the end. And there is some argument that the UK can't actually default on its debt, or is very, very unlikely to default on its debt, because we have the ability to print our own money. So ultimately, if it came to it, we could just go, right, fine, you know what, we can't afford to pay you, we're just going to create some money and we'll pay you with that, which does create another problem that we can go into in a minute. I don't want to overcomplicate things here. But what you need to remember about bonds is that although there is an issue when they are newly issued to the market and they have a face value of £100 and they agree to pay you 4%, for example, they're then traded on the secondary market. And when they're traded on the secondary market, depending on how much demand there is for two things, the interest rate that bond pays and the perceived quality stroke safety of the person who's issued the bond, that demand can move up or down. And that means that the price of the bond goes up or down. So, for example, in a scenario where perhaps you had bonds that were issued a few years ago and they only paid 2%, investors don't really want those now. because interest rates are going up, and they can see that in the wider market they could get 4%. So you wouldn't go buy a bond that pays you 2% at full value now, because you'd go buy one that pays you 4%. So you will only pay a lower price for that bond. So for example, you might find that your gilt that pays 2% is now trading 20% below its face value. So it's trading at £80. And that means that the effective yield for the buyer moves up, because they're buying a set rate of interest for a lower price. And it can happen the other way around. And actually, it's not so long ago that you had negative yielding bonds, where people were buying government bonds that they were guaranteed to lose money on if they held them to maturity, because they just wanted a safe place to put their money, and they were willing to take a small hit on it. That world seems a very long way away now with rising interest rates. And and the easiest way to compare this for an individual investor who actually, they don't tend to go out and be trading in the bond market as such, although a lot of them hold funds that do have bonds in them, is the easiest way to think about this as an individual is, if there's a government bond out there paying 2% and I can get 4% from a 1-year savings account, which you can do now pretty much, why would you buy the 2% government bond? Well, you wouldn't. So you would wait until someone was willing to sell you that at such a low price that the 2% yield had doubled to 4%. So the easiest way to explain this mathematically is to say you've got a £100 bond and it pays 2%, and it's so out of demand that its price falls to £50. So you can buy a £100 bond for £50, then the yield would have doubled from 2% to 4%, because that's the effective yield that you're getting. But then you also talk about things like yield to maturity, which involves the yield that you get each year in terms of interest, and what happens if you hold the bond to the end and then get your money back. And the simplest bit of the bond market would just involve people buying bonds as they're issued and holding them right to the end. That's not why the bond market works how the bond market works. The bond market's really complicated because a lot of very, very big institutional investors, bond funds, bond traders, bond vigilantes, even, as some of them are called, they don't just buy boring investments and then hold them to the end and collect their interest. They're constantly trading in and out of these things. And that's why we talk about yields going up or down. And effectively, the yield on a government bond is a bit of a weighing mechanism of the faith that investors have in that country, which is why we talked about in the Eurozone debt crisis, Greek bonds, Italian bonds, the prices on the yields on those soaring, which means the price is tumbling because the price moves in the opposite direction to yields, as I just explained. And that's why there's so much concern about gilt yields having leapt up in this country since the mini budget, because it indicates that there is a lack of confidence in the UK government to deliver what it says it's going to deliver, and investors want a much higher rate of return in order to basically buy our bonds. And, they're not willing to lend us money unless we pay them a lot more interest.
Well explained. Thank you, Simon. Bank of England, though, what are they up to? Why is that significant?
Well, this is where it starts to get complicated. Obviously, the bond market, if it just sort of moved around like one of those little tickers that you see at the top of your screen when you're watching something, and it's got the price of something, or maybe like the football results scrolling along the top of Sky Sports News, that would be fine, except it doesn't obviously operate in isolation and not affect lots of other things. And because it's considered to be the safest part of the market, which many would argue for many years post-financial crisis, it hasn't been the safest part of the market at all. The safest part of the market has displayed an awful lot of quite extreme volatility and weirdness going on for the past 15 years or so. But you've got, for example, pension funds hold large amounts of gilts. And we're talking here about defined benefit pension funds. So pension funds that have employers, pension funds that promise to pay people a set income in retirement for every year that they've worked for that company or that organization. And they are legally bound to do that. It's really difficult to wriggle out of that. You have to effectively go bust to get out of that. And there is then a pensions lifeboat if that does actually happen. People who haven't yet retired may lose some money. People who have retired are pretty much fully protected. So that's why they're called gold-plated pensions, defined benefit pensions. But on the other end of your gold-plated pension is somebody who has to provide that, and that is a pension fund. And pension funds, because they don't want to take too much risk and they want to know how they're matching up the amount of money that they've promised to pay out with the investments they have to pay it out, tend to operate in the more cautious end of the market. Somehow that has translated into pension funds investing heavily in derivatives. Derivatives tend to be the riskier end of the market. We were talking about this the other day in the office, and I was saying that in no scenario where there's some form of blow up in the derivatives market does the people who have bought the derivatives based investments ever come out better. It's always the people who sold them to them. And pension funds are on the other end of this at the moment. So they've been investing in these liability driven investment funds, which are very complex. Basically, the idea is that this protects them against sudden moves in the gilt markets and currencies. And it's effectively a kind of hedging strategy. But what comes with investing in derivatives, just to make this at the most simple level, is that if markets move too far against you, you can get something called a margin call, where you are asked to hand over some more cash in order to back your investment. This happens to people when they're spread betting, for example. This is why spread betting is so risky, because the market can move in such a way that it boots you out of your position unless you put more money into your account. People just end up chucking this money in. Now, the pension funds aren't spread betting. They're not taking that level of risk, but they have had these calls for collateral, these margin calls. And in order to meet that, they need to give some cash, but they're not sitting on lots of cash that they can just hand over. They have a liquidity issue, is what you would say. That means basically you don't have enough liquid funds in order to hand some over to the person who's asking you for them. So what they're having to do is they're having to sell some of their actual investments in order to raise the cash. So they've been having to sell some of the gilts that they hold, and they tend to hold long-dated gilts. So the first intervention we saw was in the long-dated gilt market, 30-year gilt market. And what happened after the mini-budget was investors decided that they wanted a better rate of return if they were going to be lending money to the UK. One of the reasons was because Kwasi Kwarteng stood up and announced £45 billion worth of debt-funded tax cuts. And if you announced £45 billion worth of debt-funded tax cuts, that means you're going to be releasing a lot more of these bonds in future into the market. So effectively, you're saturating the market. And things have changed. Mark Carney was talking about this week. He said, you could get away with this like 5 years ago. £45 billion more bonds. Yeah, great. Guys, we're buying stuff with a negative yield. We'll take whatever you've got. That's not how it works anymore. People aren't taking whatever you've got. And I think that was one of the major missteps in the budget and the miscalculations in the budget. And also, the way it was delivered without the costings and stuff. So this happens. So investors go, we want a higher rate of return. We know you're going to be issuing a lot more of these. You're saturating the market. We want more. So bond yields spiked. This caused the problem for the pension funds. The pension funds then have to start selling their bonds, which causes the prices to fall even more. And that means that the yields go up even further. So you were getting a negative feedback loop. And the problem was that the pension funds were caught in this vicious circle. So the Bank of England steps in, says, we are going to be a buyer of these bonds. So the pension funds have someone to sell them to. There have been some problems with the way it was structured, in that the Bank of England has been buying bonds at close to the market price. It's a sort of auction system, and it was hoping that it would provide this backstop in the market, but it's not actually bought as many bonds as people thought it was going to buy, and I think as it thought it was going to buy, because it's not had that many offered to them, because apparently due to the structure of this, and because the bond yields are moving so quickly, people selling those bonds have to wait to find out whether the Bank of England is going to buy them off them. But in the meantime, prices might have moved against them. The pension funds, I think, probably thought that this was going to get pushed further, which is why Andrew Bailey said what he said this week. And they thought, yeah, they'll keep this blank check open for us. So it's not worked as well as it has. And also the Bank of England doesn't want to be seen to be doing what it did, doing more quantitative easing. So instead of saying, like it did with QE, we're going to buy X amount and we'll just pay the price, whatever the price is, which does have much more of an impact on bringing yields down. It didn't do that. So it's all ended up a little bit of a mess. Does that explain it?
Yeah. Well, Lee's nodding along there. Not forgotten about you, Lee, but I think Simon's doing a sterling job here.
I think the important thing to remember here, actually, because somebody asked me about this week, is people don't need to worry about their pensions, right? So this is defined benefit pensions for a start, which most people don't have nowadays. They're old type pensions. The only people who, generally speaking, get to pay into defined benefit pensions now are public sector employees. Most companies have defined contribution schemes now, but a defined benefit scheme, as I said, they've made a promise to pay you that money and they're legally bound to do that. These big funds, they don't go bust that often. It does happen, but there is a lifeboat. You are protected. There's a huge amount of protection built into defined benefit pensions, and people don't need to worry about their pensions. And there was never a question, that the whole pension fund was bust in the way that we've heard before when pension funds go under. It's just this little bit of bad investing and things moved against them that went wrong. And with a defined contribution scheme, which is what most people have nowadays, you pay money in, your employer pays money in, that money is invested into the stock market, into other assets and so on, and you try to build up a pot for retirement. And that part of the pensions industry is not affected by this whatsoever.
Good to know, because the question I was next going to ask you is, how does this affect me?
Well, I mean, in that sense, it doesn't affect you, in the sense that the reason why this is going on is that markets are in turmoil. It does affect you because it's not having a great effect on stock markets, even though the stock market and the bond market are separate. Stock markets are down. Lots of people's investments are down. And if people have invested into bonds, as has happened, and there has been this lifestyling thing that goes on where people shift into the safer asset of bonds towards their date of retirement, then their pension investments could have been quite heavily dented by what's gone on at the moment.
Mortgages, Simon, mortgages. Why are bond yields a problem for mortgages? Let's go there.
Why are they a problem for mortgages? Because, well, mortgage rates and bond yields are not directly related, but once again, it's something that heavily influences it, in the same way that mortgage rates and the Bank of England base rate are not directly linked, but the Bank of England base rate heavily influences the price of mortgages. So as we've seen the cost of borrowing in terms of like gilt yields go up, as we've seen interest rates go up from the Bank of England, we've seen a big jump in mortgage rates. Part of that is an expectation that the Bank of England is going to have to raise interest rates by more than was previously thought. There was also this thought there might be an emergency rate hike, which I think we've probably knocked on the head for now, but there's an expectation of another 0.75 percentage points come the 3rd of November. That's going to take us to 3%. Mortgage lenders were, they have to raise funds. They don't want to get caught out by the market. They don't want to misprice. They don't want to accidentally end up with a massive influx of business because their rates are suddenly much lower than all their rivals. They'd rather play it cautious and take a step back. Many other reasons. We've seen mortgage rates spike substantially over the past month. And actually, to put this in context, if you wanted one of the best 5-year fixed rates now, you would pay 5.5%. If you had wanted one of the best 5-year fixed rates at the start of September, you would have paid 3.5%. That is a really big jump in mortgage rates. It's the difference of just over £200 a month on a £200,000 mortgage. And a year ago, you'd been fixing at 1.5%. And that's a difference of £400 on a £200,000 mortgage.
Simon, if a lot of the problem here is investors don't trust our government, is there anything that can be done that can turn this around? Because there's a lot of talk about U-turns, and we don't want to get political, of course, but that surely in itself is not going to instill confidence if you're going to change everything you've just set out like about 2 minutes ago. So can you put the cat back in the bag, or whatever the expression is?
No, you can't put the cat back in the bag. And I don't actually necessarily think that a colossal screeching U-turn on every single bit of the mini budget would be the wisest course of action. I personally think they should stick to their guns, because I honestly believe that. So say we go all the way back to where we started, like say they reversed everything, well, then we'd have had all this carnage for what? And we're still going to be in a worse position because we've lost faith, trust, authority, all those other things. Secondly, they can't reverse the energy bill stuff. Okay, so let's take that one out of the equation, right? The energy bill stuff, I think, is hugely costly, but they had to do something. And I don't know what the answer was to what you do that solves the problem without it being hugely costly and then all the bits of problem involved in it. And then you get to the tax stuff. Well, they don't want to wind back the 19p cut to 19p from next April. They certainly don't want to wind back the hike stuff, the national insurance stuff, because I mean that was a cornerstone of Liz Truss's campaign. So what are they left with? Well, corporation tax, which it looks like it might be the thing that they wind back on. And the thing about corporation tax was cutting that isn't really the most popular move anyway. It's not, businesses weren't even massively calling for it. So it was a bit unnecessary. But then, the icing on the cake was as we've said, that overshadow your own tax cut for everyone by cutting tax for the rich, and everyone just talks about you cutting tax for the rich. I don't know what they do in this scenario, but it is worth saying that it's not only about the mini budget, but the mini budget was the straw that broke the camel's back in a sense and caused all the problems of the last month. You can't pretend that it had nothing to do with that. But you've got to go all the way back to the financial crisis for this. And actually before that, this is ultimately the unwinding of the cheap money era, the sort of endless magic money tree stuff post-financial crisis. It was always going to be painful when we moved back towards normal interest rates, when we started unwinding QE. There was this belief for a long time that we'd never really properly unwind QE. We just sort of allow it to move into the background and like end up in a cupboard somewhere, forgotten about. And then like 20 years time, someone would clear out the cupboard and go, oh, do you remember that QE we did? We never got rid of that, did we? Oh, well, let's move on. Hey, but now we're talking about, QT and quantitative tightening, where the central banks are selling the bonds back into the market at the same time as governments trying to raise more debt. And you've got, we held on to the super low interest rates era for so long, and we believed that inflation was never going to come back and be a problem, that people have built entire investment hypotheses and global companies that are household names off the back of it, right? It was always going to be hugely disruptive. And that was the colossal miscalculation with the way the mini budget was delivered, uncosted, un-OBR'd, just like chucked out there, boom, 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 boom. With the world's changed, you can't get away with that stuff anymore.
Yeah.
So yeah, I don't know, I don't know what we do now, but you do have to remember that, the shift from super low interest rate world of fixing your mortgage for 5 years at 1%, that was never going to last forever. That always had to change. We always had to go back to somewhere near normal. And it is really important to try to get to somewhere back near normal, because it stops the wild skewing of every single market you can think of that has been caused by super low interest rates. I mean, house prices are so ridiculously high because interest rates were so low for so long. And the readjustment from that is always going to be painful. The question is like, are we now at the point where in this country, where we wake up and it was all a dream, and like Bobby Ewing, Rishi Sunak steps out the shower?
Lee Boyce, I have not forgotten about you. Is Britain's reputation somewhat trashed? Alex Brummer has been writing and says Britain's reputation for sound money is being swept away, and that's deeply worrying for us all.
Can I just say that
you
quite
can.
often I'm just a This Is Money podcast listener, and just listening to Simon explain all the madness that's happening in the gilt markets is always entertaining, especially when he starts bringing in Dallas references. I mean, that is I don't know if I've heard that
so
one
good.
yet. I mean,
Yeah, just actually for the benefit of our younger listeners, okay, there was a famous scene in Dallas. Dallas was a TV program that was on when I was a child, right? And it was set in Dallas, and it was oil families, and it had one of the greatest theme tunes of all time. Bobby Ewing was one of the main characters. Bobby Ewing died. And then they did one of the all-time great about faces, one of the all-time great screeching U-turns on TV of our time, where they decided that actually, do you know what? They were just going to bring back Bobby Ewing. And so Bobby's wife, I think it was, wakes up. It turns out it was all a dream. Bobby hadn't died, and he steps out of the shower. So there you go.
Great.
And the other one
Simon.
is
you
when
can
people,
Gilts to Dallas to 80s TV
also
shows.
For other younger listeners who don't know their cultural references that us dinosaurs use, jumping the shark, that comes from Happy Days, where Happy Days was a TV program set in this kind of like 50s rock and roll thing. There was the Fonz, he was there. And the point when it was considered to have got completely ridiculous was where the Fonz jumped a shark on water skis.
Right. That's beyond me.
I'm not a dinosaur. I got the Dallas reference. I'm only 35. I mean, come on. I think most people will know the reference, though. Anyway,
we digress.
Is reputation tarnished? Is your question? Well, actually, I think it's quite interesting. We were having a conversation in the office this week about the IMF. They've got their annual meeting at the moment, and Simon had some brilliant views on the IMF. But one of its top regulators said that basically Britain's paying the price for having two people in the driving seat, each trying to steer the car in a different direction, aka the Chancellor being pretty loose with his tax cuts and the Bank of England tightening interest rates. Now, I remember when it wasn't that long ago when we reported on the mini budget, and we did the mini budget on that Friday. It was absolute carnage, and we recorded a podcast, and I actually thought we didn't do a bad job on it considering all of the mad stuff that got thrown in there. But I remember Simon saying pretty much the same thing about, I think, maybe 1 foot on the brake, 1 foot on the gas, and that's what that made me think of, and that's what it feels like. Money men around the world are kind of looking at Britain and thinking that's what's kind of happening. And I also remember off the back of that mini budget when we did say things like there was no OBR report, and it looked all just a little bit sort of like frantic. Like all of a sudden, there was a budget and there was just so much thrown into it. And that does cause, instability. I think that it kind of, people from the outside looking in are going, hold on a minute, what's all of this sort of like, massive tax packages that have been announced from nowhere? And actually, I say from people from the outside looking in, I think people in the inside looking in were kind of caught a little bit out by it, thinking, what on earth's going on? And I think that actually, the whole thing that's happening with gilts, the yo-yoing yields, 1 minute they said be rocketing, the next minute they're falling again, with the Bank of England intervention. I think it has tarnished a little bit. I don't know how long term we're talking, but it just makes everything seem a little bit more unstable. And when you start saying unstable and economics and finances all in the same breath, it doesn't look good.
So where do we go from here, Lee?
No, George, I don't know. I couldn't tell you. We've got the
Nah, Georgie, just don't even go there.
We've got the fiscal plan on Halloween, which is obviously an interesting time to do a fiscal event.
The headline writers, yeah.
And then I think I'm right in saying a few days after that, there's a Bank of England base rate decision.
November. Yep.
So we're now, the forecasts I've read this morning for interest rates are that they're not going to go as high as what was kind of being forecast even just a couple of weeks ago, possibly by screeching U-turns and all sorts going on. So where do we go from here? Well, I'm just taking things one day at a time.
Best advice, Lee.
And
in life, in work, in fiscal statements.
For anyone sort of listening to this, and you ask Simon about, how does it affect you? It does affect people in certain ways, as Simon said about things like stock market. It's been a lot of kind of ups and downs. Fundamentally, I think, and this is what we were kind of saying in the podcast recently, is it's a kind of like don't panic type scenario in my mind. It is easy to say that when, I am basically looking at this from the outside because I do have a fixed mortgage, for example, and people that are now, potentially remortgaging or trying to get a new mortgage are facing rates that are high compared to, the last 10, 15 years. But it's just about not panicking. I think it's all about taking things as they come at the moment, let's just survive until the new year and see what happens from then. And I think that a lot of the forecasts are for inflation to peak this month. Whether that will, come true or not, there's lots of factors at play. So we'll see.
What we need is for inflation to peak in the US. So there's another dynamic here, which is that the strength of the dollar and the fact that the US is raising rates faster than the UK and pretty much anywhere else. And because the dollar is the world's reserve currency, and going back to the safety of government bonds and so on, investors are just putting their money into US government bonds, which then creates more demand for the dollar, which drives the dollar even higher. And until we see inflation peak in the US, we're not going to see the Fed take its foot off the gas in terms of rates. The Fed is in a slightly different position to the Bank of England and to the ECB, in that the US economy is arguably actually stronger than our economy, and that their inflation is less being driven by the outside factors of energy prices and stuff like that, because they're a lot less, well, they've got a lot more energy self-sufficiency than we have, or the rest of Europe has. So ideally, we need inflation to peak there, and to peak soon, and then the Fed to take its foot off the gas. And you're now starting to see a lot of questions asked about the Fed's policy and the problems it is causing for the rest of the world. That's probably one of the next things that comes to a head, to be honest. And unfortunately, it was hoped that inflation figures from the US this week would start to show that kind of like leveling out, and it didn't. That hasn't really happened. So yeah, we everybody needs Team America, World Financial Police, to step in and do something here, because it's not just causing us a problem, it's causing other countries a problem. The yen has slumped to its lowest level in 24 years as well. So, and this is a problem for Europe too.
That's it for part one.
I'm joined now by Sam North of eToro for our weekly look at the markets. Sam, another quiet week on the markets. Not a lot going on, really, was there?
Yeah, another quiet one. It's not too much to ask, just for one quiet week in 2022, is it? Well, apparently so. Another chaotic few days, and from a UK perspective, it seems it will continue long into the night and into the weekend, following Kwasi's sacking, Hunt's appointment, Truss removing the plans to cut corporation tax, the U-turns. Right now, they don't seem to be enough to calm the markets. The pound suffering right now on Friday, as did gilt. And this alone would have been enough drama for 1 week, but on Thursday we had US inflation, which came in higher than expected. The Nasdaq actually going into it was up 1% before the announcement, then down 3% after, before finishing near the high of the day. So absolutely bonkers price action really in markets. Potential reasons, maybe a bit of seller exhaustion. We've been on this dramatic move lower for quite some time now, which would be good if that was a reason. Some analysts mentioning as well inflation number being a bit of a lagging indicator, so that might have helped the recovery too. But yeah, either way, the volatility in the markets, while amazing for day traders, isn't really going to fill investors with too much confidence.
No, I think there's a lot of people feeling that it's the time to hunker down, and you can always tell when markets are in trouble because we start watching gilt yields, don't we?
Yeah.
Nobody ever mentions them when there's not trouble on the horizon.
Very true.
What do we have to look forward to next week?
Well, I'm not even going to bother saying that it's a quiet week, because it won't be. But from an economic data point of view, it's actually not that busy. We've got a bit of Chinese data to begin the week, so that will come out on Tuesday or Monday evening, depending where you look at it. And other than that, we got UK inflation on Wednesday, so definitely keep a watch on that, and then retail sales on the Friday. But with no major data points from the US, I guess we'll focus a bit more on the earnings. So we've got companies like Netflix, Goldman Sachs, IBM all reporting, so that'd be worth keeping a watch on. In the UK, I think it's start of the half term in some places, so usually it's quite a quiet week. But for any UK market related traders, you got to keep an ear to the ground for any developments, and who knows, by Monday everything could look completely different. One thing for sure, and I mentioned this earlier, investors hate uncertainty, so there still looks to be quite tough times ahead, and until we get less bad news or positive news, I think markets are going to struggle to find a floor.
And just before we go, with that UK inflation number, we're not expected to see it having peaked yet, are we?
No, I don't think so. I mean, you've still got some analysts thinking we're going to push into the high teens and 20% next year, which is, I probably think a little bit unlikely, but the more people talk about it, it's just going to become a bit of an expectation, really, that inflation is going to keep coming in hot.
Okay, Sam, well, thank you very much. And we will speak to you next week.
Welcome back. On to happier subjects. Lee Boyce, savers can now earn 5% for the first time in over a decade. It's after Atom Bank launched a new Best Buy 5-year fixed rate deal. Savings rates have been on the up over the past year, but have been turbocharged, Lee. God, you're rubbing your hands there. You're so excited. Your face has got a little bit ruddy again. But blink and you may miss some of the best deals. So, Lee, what is going on? What's been happening over the last few months?
Genuinely, this week, Georgie, in the office, I have been rubbing my hands quite a lot when I've been getting emails in for new savings rates. That I live and breathe this stuff, and I absolutely love it. A few weeks ago, we saw the first fixed rate come out paying 4%, and we were like, "Wow, okay, here we go. Savings rates on the up." Well, just a matter of a few weeks, 5%. So you can now get a 5% savings rate. Now, look, inflation is, as we know, it's almost double digit. So you're still losing money in real terms. But after a decade of absolute pittance that you could earn on your savings accounts, a 5% rate is a pretty big benchmark to breach. Now, it is a 5-year fix. 5-year fix is very niche product in the savings world. Not many people will take out a 5-year fix. But that 5% benchmark is still quite important. Psychologically, we'll see more banks, more challengers, come out with good rates. And actually, the interesting thing about the Atom Bank deal is that you can have the interest paid to you monthly. So you can have a monthly payment into a different account come to you. So for some people, they might like that kind of stability. A 5% return a year might be attractive to some over 5 years. Now, I think the one thing I would say of Atom Bank as well, that it's app only. So you have to apply for it on the app. And again, that won't suit everyone. But for some people, they'll be more than willing to do that. And importantly, it is FSCS protected. So all the savings accounts we ever mention on the website have that FSCS protection. It basically protects your cash up to £85,000 if anything went wrong with the bank. We tried and tested Atom Bank. Our savings reporter, Ed Magnus, has opened an account with them. He tries out quite a lot of these places just to make sure, the customer service and it's all smooth and that kind of thing. Now, I think also significantly this week, and this is actually probably the bigger of the savings news. Now, the 5% is great. We've actually had a number of Best Buys come out from Santander and Coventry Building Society, two really quite big players in the savings world. So Santander, obviously a huge bank, Coventry Building Society, one of the biggest mutuals after Nationwide, and they, pack some punch. So Santander is offering an easy access account at 2.75%, which beats absolutely everything else in the market. What that does is it makes other challenger banks and smaller building societies have to start pumping up their rates for easy access, because people will just head to Santander because it's a trusted name. And people will be happy to open and move their money into that savings account. And it is one of those things where there is still a lot of money languishing in absolutely dreadful easy access accounts, still paying, under 0.5%. Don't let that be you. Look, 2.75% of Santander is worth moving to. You don't have to fix your money. Santander's also come out with some good cash ISAs this week as well, Georgia, and that has been an area that has been neglected for a long time. Santander now have got basically 3 Best Buy cash ISAs. My pick of the bunch is an 18-month fix at 4%. I mean, that's pretty tasty. That's pretty good in what we have seen. If not that there's much to compare it to. But it's just basically off the Bank of England base rate rises. We're starting to see competition, and the competition up until the last couple of weeks has all been driven by smaller players. When you start getting these big names in, that's when stuff really starts to happen. And Coventry has got a fixed rate at 4.85%. So that 5% over 5 years is obviously quite a niche product in the fact that, that's quite a long fix. This 4.85% is like it's a 3 and a bit year fix. So it's fixed to the 31st of December 2025. So it's basically like a 3-year 2-month fix. at 4.85%. So you'd be forfeiting that 0.15 percentage point interest, but at the same time, it's almost 2 years less to fix for. So there's lots of options out there now for savers. As you rightly say, we are seeing a bit of the blink and miss them kind of accounts. And what we mean by that is we are seeing some rates being launched 9 a.m. in the morning and they're gone by the afternoon, 3-4 o'clock. We're in that kind of territory where, again, this is really the smaller players in the market. This isn't your Santanders and your Coventries. This is more like a certain bank will have a certain funding requirement. They want to put in this amount of money to fill up this fixed rate. We don't ever know how big that pot is. If it gets filled, the rate gets pulled. So the best thing to do really is to act with your money. A lot of people will be still parked, sitting around thinking, well, hold on a minute. There's probably going to be more base rate hikes. Savings rates are probably going to continue to go higher. And I completely understand that logic. But what I would be thinking about potentially is at least having a Best Buy Easy Access rate, or having some of your money in a 1-year fix or an 18-month fix, and see what happens in the next few months. As always with a lot of these things, you can sort of sit around and then just sort of miss out. And you think, well, actually, maybe next month there'll be a 5.5% rate. But then you kind of in that danger territory of, but your money's still languishing in the 0.5% rate. So you would have been better off just putting it in that 5% anyway and not forfeiting that month of interest. So there's lots of things to balance and think about and spreading your money around. But the good news is that there is at least options for savers now. And I think also with the premium bond moves a couple of weeks ago, it all just feels a bit rosier for savers all of a sudden. So where we've got on one hand, mortgage rates going up, certain people might be worried about mortgage rates going up because they're about to remortgage or they're looking to buy a home. On the other hand, we've got people that have been starved of interest payments for a very long time that are rubbing their hands and going, wow, okay, finally I can get a return on my cash.
On the flip side of all of that, Lee, though, I want to ask you about mortgage rates. Simon touched on it earlier. They are high, but apparently house prices could fall. We've heard that a few times over the last few years. What does it mean, though, for first-time buyers? Let's take a look there, because it's a difficult moment for first-time buyers, is it not?
Well,
what do you do?
Before
it's a bad time to buy?
Well, I think before I start wading into the rates and all that kind of thing, fundamentally, if you're a first-time buyer and you have made an offer on a house, quite often there's a lot of first-time buyers that might have had a offer accepted at the start of the year. It's never just a quick process buying a home. So there'll be some first-time buyers out there, for the first sort of 4, 5, 6 months of the year that would have secured a mortgage at a rate that looks very, very good compared to now. And that offer still stands. It's not like a lender will withdraw that offer. What's happening is lenders are withdrawing products, not withdrawing offers from people. So first of all, there's that factor. Second of all, if you are a first-time buyer, it's a scary thing anyway, buying a first-time home. And then you see all this stuff in the news about mortgage rates going up. Then you start seeing things in the news about house prices falling potentially 10% next year, for example. There's been a couple of reports in that kind of ballpark where mortgage rates are going up. I think if you're a first-time buyer and you're buying a home and it's a home that you can live and grow in, and you're not looking to buy a home and thinking I'm going to sell this in 2 years and move somewhere bigger, and it's somewhere potentially at the moment, I would argue for a bit of a longer term, time flies. And I've had so much good advice from Simon over the years, and especially when I was buying my first home 6 or 7 years ago, about what it is that you actually need from a home. And I think usually, as I say, time flies. You end up in a property, you don't want to outgrow it. So it's about buying the right first time property for you, and making sure you're going to be happy there for 5 years. That's what I would argue. That's what I would say. Now, you're right, rates are going up, and we're in a bizarre scenario in which a 2-year fix at the moment, on average, is more expensive than a 5-year fix, which is just like everything's been sort of flipped on its head. Which again adds to that kind of degree of uncertainty. I think always a good broker is worth their weight in salt, especially at the moment. I'm sure they're busy and inundated, but if you can find someone, a good recommendation from someone that's used a broker in the past, they can go and source you the best deals and do a lot of the legwork for you. So it's worth considering that as well. But don't let it steer you off course. We've seen house prices grow in the last couple of years, as we keep saying on this podcast, like quite unbelievably after those real, doom and gloom predictions at the height of the pandemic, right when it first started. And then with the stamp duty holiday, things sort of loosened up, and we have seen the house prices climb quite a lot. And I think a lot of people are sort of thinking, wow, they've got to fall a little bit at some point. And I keep thinking, what if they fall 10% next year? Well, we've just seen prices grow, 25%. So it's like wiping off a bit of that gain. But if you're about to buy your first home now, that's a worrying sort of figure to hear, and you don't want to be buying at the top of the market. But as I said to you, I think I said on the podcast recently, I remember buying my house in 2016, and I was completely freaking out that I was buying at the top of the market, that I was suddenly going to be burdened with this massive debt in this house that was going to go into negative equity. I grew up in the financial crisis, into my adult years, and I saw how people got burned. So it was always a concern and a worry. I think you've just got to take your time, make the right checks, do the right things, and just don't steer off course. Buying a home is a very exciting time. It shouldn't be full of fear and full of worry. It should be, I'm about to become a homeowner, and it's exciting, and I can afford this.
All right, then. Finally, Simon, it's been quite the horror show for markets recently, but where there is uncertainty, there may be opportunity. Investors looking for a bargain may be eyeing the UK's investment trust sector, where discounts have been stretched to their widest level in years. Tell me a bit more about this, Simon.
Firstly, I would ask the question of everyone: when do you like to buy things? Do you like to buy them when they're expensive, or do you like to buy them when they're on sale, when you can get a discount?
Yeah.
I think most people like to buy stuff when they can get a discount. I think we've all become a bit wary of discounts, like experts, as was famously once said, because we see too many of them. We don't really trust that they are actually real discounts, just like we don't really trust that some of them are real experts. But there are examples where stuff is genuinely on sale. And you could argue that when stock markets are down substantially, as they are at the moment, they are on sale. But it's also possible to invest in a stock market that's on sale in an investment trust that's on sale as well. Because investment trusts are essentially a fund where people have money invested and then they invest into other things. Except investment trusts themselves are listed on the stock market. And so they have shares. They are limited by shares. And that means that unlike an investment fund, where when somebody sells out, the investment fund has to sell some investments and it shrinks in size, or when somebody buys in, the investment fund takes their money and it has to go buy some more investments and it grows in size. Investment trusts stay the same size because they're limited by shares. And that means that their share price can be different to something called their net asset value, which is effectively the sum of all their parts, all the things that they hold together, valued together. And it means that you could potentially buy £100 worth of assets for £90 if that trust is out of favour, or if the thing that trust invests in is out of favour, or if just the stock market in general is out of favour. And it's worth noting, though, that you should never just buy an investment trust because it's trading at a discount. And hang on a minute, what's this Lee is showing me on my in front of me at the moment? It seems to say that Kwasi Kwarteng, we think, is at this point being sacked. He's flown home from the IMF to be sacked as Chancellor. And who knows what's going to happen now? This just gets weirder and weirder. So we're not, what I'm going to say, right? I'm making a call, right? In action right now. Okay.
Go for it.
We are not going to re-record the whole start of this podcast to take into account that Kwasi Kwarteng may or may not have been sacked.
It over and over again, Simon, the way this government's going.
Okay, right? This is not a scenario where we wake up, the alarm clock's going, it's playing Sonny and Cher. Oh no, here we go, Groundhog Day. We are going to finish the podcast, but just to let you know, if you have listened to the end, the man who was Chancellor at the start may not still be Chancellor at the end.
We're recording this at 11:40 in the morning, so we're not sure. We think he might be gone.
Yeah. let's go back to something that's lasted a lot longer than Kwasi Kwarteng. Investment trusts. They are one of the oldest investment vehicles that you can find. In fact, they are the oldest investment vehicles you'll find in this country. Many of them date back more than 100 years. Scottish Mortgage, for example, invests in some of the world's most exciting companies. We are talking the cutting edge disruptors of the world, the ones that they think are going to change the world in 10 years' time. Scottish Mortgage launched on the 17th of March, 1909. Okay, how's that for longevity? But it is an example of an investment trust that is trading at a discount. Did you like my segue there, everybody? Right, so it's trading at a 13% discount at the moment. But for a lot of the last few years, it's been trading at a slight premium. So a 13% discount is a major, major, major discount for a trust like Scottish Mortgage. Why is that happening? It's because the kind of stuff that Scottish Mortgage invests in is very, very much out of favour. It is heavily invested in disruptive growth companies. And in case anybody hadn't noticed, disruptive growth companies is not what people want this year. It has what has led the US stock market considerably lower. I'm looking at the top 10 investments here. Moderna, the famous COVID vaccine, mRNA maker, creator, inventor, what do you want to call it? Tesla, it's a big Tesla holder. It's done very well off Tesla over the years and has backed Tesla for many, many years when many people said Tesla was a complete busted flush, and has made a lot of money on Tesla for Scottish Mortgage investors. Not in recent times, but if you look at it over the long term, it has. ASML Holdings, chip designer, Illumina, Tencent, Meituan, Amazon, Neo, Caring, Mercado Libre, a lot of the kind of stuff that's out of favor. But that means that as an investor, if you believe that Scottish Mortgage's investment strategy really is a long-term investment play that you can get behind, and you think that, yes, prices go up, prices go down, but these guys know their onions and they believe that they are picking the companies that are going to be a huge success and change the world in the next 5 or 10 years, then you might think that is an attractive proposition to go buy those shares at a 13% discount. But don't just buy them because they're at a 13% discount. You have to think about it first, whether the discount is worth having. And that goes for any of these investment trusts that is trading at a heavy discount. But it does kind of indicate that we're at a moment of very high pessimism, and often, as someone once said, who's also shown potentially more longevity than the Chancellor, Warren Buffett, be greedy when others are fearful. Just be careful about how greedy you are, because people can get more fearful. He didn't say that bit. That's the bit I added.
Thank you very much, Simon. That's it for this week. You can keep up. God knows what's going to happen next week. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team, anything you'd like them to look into, Simon.
You can email us at editor@thisismoney.co.uk. You can tweet us at thisismoney. And you can come to thisismoney.co.uk/podcast to listen to all podcasts past and join in the debate in reader comments.
And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.
Market updates and conversations around the financial world don't have to be boring. The Digest and Invest podcast by eToro is a great way to tune into what's happening in a fun and easily digestible format. Discover the Digest and Invest podcast at etoro.com/academy/podcasts.